What do you think was the biggest financial topic in 2022? Hi, and welcome back to another Money Not Math conversation. This is Drew Erickson on January 5th, 2023. Happy New Year. I do these Money Not Math conversations because I love our country, but I believe our government is terrible at managing money and should not control our financial future, and neither should Wall Street. So let's build financial plans that make sense for you individually. And I do these videos to hopefully provide you value and those people you know value. So please, first of all, thank you for taking the time to watch or listen to this conversation. And also at the end or sometime during, please let me know what you think by leaving comments to ask questions or thoughts. Or if you have a request for future Money Not Math conversations, I always appreciate that. So let's get into today's conversation. To help us with today's conversation, I'm utilizing an article from dimensional.com titled Dimensional's Takes on the Biggest Financial Topic of 2022. So I'm going to highlight their takes and added my own thoughts. And at the end, I'm going to wrap us up by highlighting my goals to improve myself in 2023. And hopefully that will help you. One, it's going to help me with accountability, because if I tell you guys what I'm working on, well, I can't hide from it. And two, hopefully it prompts you to set some goals for yourself. So let's start us out. Market volatility, topic number one. It was a tough year in the markets, leaving some investors feeling anxious when it came to their finances. Many found themselves contemplating what such market volatility means for their investment strategies. Do downturns lead to down years? Dimensional provided some optimism by showing that a broad U.S. market index had positive returns in 17 of the past 20 calendar years, despite some notable dips in many of those years. There is not a single year when the market was always positive. There will be times throughout any year when you see the market drop, said Wes Crill, head of investment strategist at Dimensional. Most years still end up positive, even though some do end up negative. We believe you are better off staying invested rather than panicking because of a drop. So this is really, really important. 17 of the past 20 calendar years have had positive returns in the stock market. Two things on that. First, that's significantly positive, right? That's 85% of years are positive years. But also 3 out of 20 or 15% were negative. So when you are investing in the stock market, you have to go into it with the mindset there are going to be down years. So don't be surprised by it. It happens. The second thing to understand about that, or that's important to understand about what he said, is there's not a single year when the market was always positive. There will be times throughout any year when you see the market drop. So it's extremely important to ignore the daily, weekly, and monthly, and almost annual news. When they scream at you that the sky is falling, it's important to ignore them and not react. Because what happens on any one individual day or week throughout the year likely is not going to have much of a large impact on the outcome of that year. And more importantly, when we're doing long-term financial and retirement and legacy planning, what happens in any individual year shouldn't determine the outcome of your long-term plan. We have to have long-term plans, and we should make long-term decisions around our long-term plans, not to react to short-term events. All right, so that's a really important point that I could spend an hour talking about, but hopefully that little snippet just kind of prompts your memory on what happened in 2022. Stock performance in recessions. So this is topic number 2, stock performance in recessions. The potential for a recession captured the minds of financial professionals and investors alike in 2022 and continues to be a hot topic going into the new year. Our interactive chart, Market Returns Through a Century of Recessions, emphasizes the forward-looking nature of markets as it examines how stocks have behaved during the U.S. economic downturns. Ultimately, the piece shows that markets around the world have often rewarded investors even when the economic activity has slowed. So even when economic activity slows, the market often rewards investors who stay invested more than those who try to time the market and get out. The exhibit also captures the uniqueness of recessions. Each one looks different, Crill said. There is no cookie cutter recession and no absolute signal of when to get in or when to get out of the market. So it is extremely important to remember, we do not know what any one recession is going to look like, when it's going to start, when it's going to end, when you should get in, when you should get out. So do not let short-term events dramatically impact your long-term plan. Make sure you plan for short-term events and market downturns, but we can't run away from a long-term plan based on a short-term event. All right, we have to plan for these things to happen. Topic number 3, the Fed's impact. The U.S. Federal Reserve's series of rate increases reminded investors that markets tend to incorporate such actions in prices before they are officially announced. In the markets appeared to be ahead of the Fed, Dimensional pointed out to June's rate hike to illustrate this phenomenon. On June 10th, days before the announcement of a rise in interest rates, the market had already priced it in. Interest rates jumped on June 13th, but the actual announcement did not come until 2 days later. On the day of the announcement, Treasury yields actually decreased. So what's important about this? Oftentimes, people make investment decisions based on the news they heard today or yesterday. The problem with that is that in this example with the Fed, if you're making financial decisions based on what you hear in the news today or yesterday, but the markets already adjusted to the news maybe a week ago, because a lot of this information is either talked about before it happens or those in the know before we do. So so by reacting to old information that the markets have already adjusted to, you are only hurting yourself, and it's not actually being ahead of the news. It's just really reactionary, and that's where we see a lot of investors losing to the market. So it's very important to, again, for the 3rd time in a row, to remember, do not make long-term planning decisions based on short-term events that are completely outside of your control, unless you absolutely have to. All right, so continuing on, next topic, benefits of long-term investing. Investors without a solid plan and professional guidance on how to stick with that plan may have found themselves making some knee-jerk decisions about their money this year. It's natural to worry about the effect of so much uncertainty no one's long-term investments. It's natural to worry about the effect of so much uncertainty on one's long-term investments, but Dimensional co-founder David Booth is quick to point out why long-term investing is crucial. Investing in markets is uncertain. The role of markets is to price in that uncertainty. There were a lot of negative surprises over the past 25 years, but there were a lot of positive ones as well. The net result was a stock market return that seems very reasonable, even generous, Booth writes. It's a tribute to human ingenuity that when negative forces pop up, people and companies respond and mobilize to get things back on track. So throughout, they don't state it in this article, but I know one of the articles I've referenced in the past and one of the studies they've done is, historically speaking, on average, about 3 out of every 4 market years are positive, which means 1 out of 4 are negative. So if we're always reacting to the market, if this year is negative, so we get out, and then the next 3 years are positive, but we weren't in for one of those 3 years, right? So we get out after this year because it's negative. So we miss next year, even though it's positive. So we get back in 2 years from now because next year's positive. We missed out on one whole positive year, right? So that's kind of a convoluted example. But the problem is if we're always reacting to the market short term, we're going to miss out on much of the gains because 3 out of 4 years are positive. So we have to, again, understand that everything in this article and every point I made pretty much comes down to one crucial point. And what is it? That's right. Don't make long-term planning decisions based on short-term events unless you absolutely have to, because we cannot predict the market. Anyone who tries to predict the market has no idea what they're talking about, or they're just selling you a load of crap because we don't know what's going to happen. No one knows what's going to happen. We can conjecture what's going to happen and guess, but we don't know for certain. All we can do is try to use the proper planning principles when it comes to our own personal plan and remove as much emotion as possible and use as much logic as possible when it comes to a long-term planning strategy. So that is the overall, the conversation that, there's one more. Value bounces back is the last topic in this article for the biggest financial topics in 2022. After more than a decade of underperforming growth stocks, value stocks bounced back over the past couple of years. While values rebound rewarded investors who stayed in their seats, the rally led some to question how much longer its run can last. Just like data shows that bull markets often last longer than bear markets, which in other words means up markets often last longer than down markets. So good years, or there's more good years than bad years, or good months than bad months, or good weeks than bad weeks, and have higher peaks. So value runs are much longer and reach higher peaks than downturns. So I'm going to say that again, because I kind of jumped in and out of the quote. Just like the data shows that bull markets are often often last longer than bear markets and have higher peaks. Value runs are much longer and reach higher peaks than downturns, Crill said. But it is important for investors to balance their enthusiasm for higher expected returns with their tolerance for underperformance. Value investing is based on the premise that paying less for a set of future cash flows is associated with the higher expected return. That's one of the most fundamental tenets of investing. Combined with lengthy historical data on the value premium, our research shows that value investing continues to be a reliable way for investors to increase expected returns. So what this kind of boils down to is, well, generally speaking, it talks about history doesn't prove the future, right? So we never know what sector of the market's going to be up or down in any given year. So again, don't make long-term decisions based on short-term events. But also within that, he says, but it's important for investors to balance their enthusiasm for higher expected returns with their tolerance for underperformance. So that kind of comes down to the whole risk versus reward. The more potential or perceived risk you're willing to take, the more potential growth you have, but also the more potential loss you have or underperformance. So it's always a give and take there on risk versus perceived risk and where you want to place that risk, long-term versus short-term, and et cetera. So those are the biggest financial topics that Dimensional felt were covered in 2022. I'd love to hear what you think were the biggest financial topics 2022. Was it one of the ones I listed? Was it something else? Please let me know in the comment section. But with that, it's also my first Money Not Math conversation of 2023. So I want to set some goals for myself personally, and hopefully this will inspire you to set some goals for yourself. So for me personally, my life boils down to 6 core values: family, faith, financials, fitness, friends, and fun. When it comes to my family, my number one goal, everything I do in life is basically revolves around providing a better life for them or spending more time with my loved ones. So one big thing with that is not just spending time with my family, but spending focused, attentive, present time with my wife and daughter. So one goal I'm setting for myself, or a challenge, so to speak, is whenever I'm at home for family time with my wife and daughter, whether that's 30 minutes in the morning or 2 hours after work in the evening, I'm going to put my phone on airplane mode or silent so that I'm completely disconnected from the outside world and present with my family life inside my house. Faith. In 2023, I'm going to try to be the most positive person in the room as often as possible and attend church more regularly. Financials. So this is a big one. It's kind of interesting to talk about because I am a financial advisor. So people rarely expect to hear me talk about my own personal financial journey. But Brittany and I are human beings too, right? We're in a young family with one daughter, and we have aspirations and things like that too. But we've not always been perfect with our money. So in 2023, my goal is to have all of my credit cards paid off, and we'd like to buy a new house and get moved by the end of the year. Will we make it happen? I believe we can, but we'll see. So, but that's going to be a big journey. It's going to take a lot of discipline and not buying things we don't want or doing things we don't have to do so we can get to our main end goal. Fitness. I've been on a bit of a fitness journey for anyone who knows or has commented on it. I appreciate it. But at one point in time, I was at the heaviest weight of my life, 235 pounds, February 2021. That was just not great. I've gotten down to 195 now, and I'd like to reach my goal of 185. While not just losing weight, but I want to get to 185 while also still exercising and staying active and being disciplined from a nutritional standpoint. So I'd also like to continue going to the gym at least 3 times a week, staying active daily, and reaching 45 points on a monthly basis. So my dad and I do a little point system where for every day we exercise for 30 plus minutes, we get a point. And for every day that I don't have more than a beer, like a social or something like that, I get a point. So throw it in a month. If I can get 45 or more points each month, I'll reach my goal. And I know that I'm going to be significantly healthier 12 months from now than I am right now, which is great. It's just another proof of why age is just a number. It doesn't really mean much. How we feel means way more. Friends. I want to continuously surround myself with people who challenge me to be a better person. I believe we become the average of the 5 people we spend the most time with. So it's extremely important to be selective on who those 5 people are. Fun. What's the point in putting all the work and hours in if we can't enjoy life too? So I think happiness is the ultimate goal, both for myself as well as my loved ones. So I want to try and focus all of my time on doing things that I enjoy doing. I know at times I'll have to do things I don't want to do, and that comes with the territory of being an adult. But if I want to focus as much of my time doing things that I want to be doing and that I enjoy doing, so that as my life goes on and as my career develops and as my success develops, I can continuously try to delegate the things I don't enjoy doing, but that have to get done. And that will ideally lead to more happiness. So thanks again for your time today. This is my first Money Not Math Conversation 2022, where we review Dimensional's takes on the biggest financial topics of 2022, plus highlight my personal goals for 2023. At the very least, again, I appreciate everyone who took the time to listen or watch this conversation. Please let me know what you think in the comments. I genuinely appreciate it. Also, anytime you like or share my posts, I really do appreciate that as well. And last but not least, always please remember this content is not legal, tax, or investment advice. You should always consult a qualified professional regarding your personal situation. Thank you so much for your time and hope you have a great day. Bye.